$185 billion.
It's a number that it almost doesn't sound real when you say it out loud like that.
It really doesn't, and I want that number to just hang in the air for a second. 185 billion. As of today, February 9th, 2026, that is the market cap of Tether USDT.
And just to give that some scale, because, billions get thrown around so much they lose meaning, that's a larger GDP than Kuwait.
Wow.
It's bigger than Morocco, bigger than the entire economy of Slovakia.
And here's the wildest part. If we were talking about a country or, I don't know, a huge bank like Citigroup with branches everywhere and thousands of employees, that number might make a little more sense.
Right.
But we're not. We're talking about a company that, until pretty recently, didn't even have a headquarters you could just, walk into. It's run by a surprisingly small group of people. I mean, a skeleton crew by Wall Street standards.
And they built this thing from absolute zero, basically.
Which is why today's deep dive, it isn't just a market update. This is a financial detective story.
It really is.
Exactly. The mission here is to figure out, how did they pull this off? How do you go from being this niche little tool for crypto geeks to holding more U.S. treasuries than Australia? We have to understand the mechanics of it. And, maybe most important, we have to look at the skeletons in the closet. Because you don't get to $185 billion in the shadows without making some very powerful people very nervous.
You certainly do not.
Yeah.
And to do this right, we've got to look at the whole picture. So I've pulled together a pretty serious stack of sources. We've got the on-chain data from Glassnode and TradingView, so we can see where the money is actually moving.
Hard numbers.
The hard numbers. And we have the legal texts. I'm talking the actual settlement documents for the New York Attorney General and the CFTC. So we're not just going off Twitter rumors.
Okay, good.
And then finally, we have market reports from late 25 and early 2026, just to see where everything stands right now.
All right, let's unpack this beast. I want to start with the climb. Because looking at the chart you sent over, this was not a straight line up. It looks more like massive steps or giant waves.
Waves is the perfect word for it. It's an acceleration story, really, defined by three specific eras. If you go all the way back to the early days, say 2015, 2016, Tether was microscopic. The total supply was under $50 million.
$50 million. Compared to $185 billion? That's a rounding error today.
It was nothing. Incredibly niche. At the time, it was used almost exclusively on just one exchange, Bitfinex. It was just a tool for traders, really. A way to move in and out of Bitcoin without having to touch a real bank account.
A loophole, basically.
A loophole. But then we hit 2017.
Ah, yes. The first massive crypto bull run. The year everybody's cousin started asking about Bitcoin at Thanksgiving.
Correct. And that was the first wave. Bitcoin goes mainstream and Tether just expands right along with it. It ends 2017 at around $1.5 billion. But the really fascinating shift, the structural shift that matters that happens in 2020.
Okay, this is what the notes call the COVID shift, right?
Yes. But the trigger wasn't just COVID. It was the arrival of DeFi, decentralized finance. And this is really important to understand. Before 2020, people used Tether to trade. Buy Bitcoin, sell Bitcoin. But in 2020, suddenly you didn't just need dollars to buy and hold. You needed dollars to use inside this whole new ecosystem.
Break that down for me. Why DeFi specifically? Why not just use, normal dollars?
Because normal dollars move at the speed of banks. They take days to settle. They're closed on weekends. They need SWIFT codes.
Right. They get stuck.
They get stuck. DeFi protocols, they're like robot banks running on the blockchain.
Yeah.
They're on 24/7. They needed a dollar that could move at the speed of code.
Right. You can't wire money from Chase into a smart contract at 3 in the morning on a Sunday.
You absolutely cannot. So Tether became the oil for this new engine. People are throwing billions into these things called yield farms and liquidity pools, basically lending out their crypto to earn interest. And the easiest, fastest way to move that value was USDT.
So the whole demand shifted. It went from, I want to trade, to I need this as a utility token to access the financial internet.
Precisely. That's the structural shift. And the numbers, they just prove it. In 2020 alone, the supply didn't just grow, it exploded from about 4 billion to 20 billion.
A 5x increase in 1 year, in 12 months.
And then the floodgates really opened. I'm looking at the data for 2021, and these numbers are they're kind of silly. They went from 20 billion to nearly 80 billion. But something in the research caught my eye. A huge chunk of that growth wasn't on Ethereum anymore. It was on Tron.
That is a critical detail that most mainstream finance reporting completely misses. In 2021, the supply on the Tron network just jumped from like 6.7 billion to nearly 40 billion.
Why Tron, though? I mean, isn't it considered a bit I don't know, messier than Ethereum?
It's cheaper, a lot cheaper. Transaction fees on Ethereum can be really high sometimes. Tron fees are pennies. So this signaled that Tether was moving beyond just, high-value institutional traders and becoming a payment rail for smaller transactions. We started seeing massive adoption in Asia, Latin America, emerging markets. So this is where the geopolitical angle really kicks in.
Exactly. I mean, if you're in Turkey or Argentina and your local currency is losing 50% of its value every year, you want dollars.
Desperately.
Because you can't just walk into a bank and open a USD account. So what do? You download a wallet and you buy USDT on Tron. It's peer-to-peer, it's fast, and it protects your purchasing power.
That is fascinating. So the 2021 growth wasn't just speculation. It was actually people trying to survive inflation.
Correct. And that sticky demand is why, when we hit the crash in 2022, Tether survived. I mean, remember, Terra Luna collapsed.
Yeah.
Three Arrows Capital collapsed. FTX collapsed.
It was a total bloodbath.
It was. And Tether's market cap, it fluctuated in that $65 to $80 billion band. There was some panic sell-offs, sure, billions left in a few days, but, and this is key, it held the peg. It didn't collapse.
Which brings us to today, the acceleration wave. We're sitting here in February 2026, and looking at the last 12 months, the chart has gone vertical again.
It really has. From early 2025 to now, they've added roughly $40 to $60 billion in market cap. And that's what pushes them up to this 185, 187 billion mark.
But why? The big crypto hype cycle has kind of matured, so where is all this new money coming from?
It's the stablecoin of choice narrative, just cementing itself. It's not just for trading or DeFi anymore. In a world of fragmented global finance, Tether has become the offshore dollar. It's the plumbing for the global offshore economy.
Okay, so that explains the what. Now I want to look at the who. Because when you think of a company managing nearly $200 billion, again, bigger than Kuwait, you picture a skyscraper in Manhattan. Hundreds of compliance officers, a whole board of directors.
And that is where Tether is unique.
Yeah, that's putting it mildly. The leadership circle is incredibly small, isn't it?
It is so tightly knit. And it overlaps heavily with Bitfinex, that exchange we mentioned earlier. It's essentially a handful of early crypto adopters.
So let's meet the cast. Who are the people holding the keys to this massive vault?
Well, you have to start with Giancarlo Divicini. He's the CFO of Bitfinex.
The money man.
More than that. In the industry, he's often described as the strategic brain. The decisions on the reserves, where to invest that huge pile of cash, that usually traces back to him. He's extremely private. Rarely gives interviews, but by all accounts, he's the architect of the whole financial strategy.
Then you have the guy everyone sees on Twitter, or X now, I guess, Paulo Arduino.
Right. Paolo's interesting. He started as the CTO, the tech guy, but he's really evolved into the CEO and, well, the public face of the company. He's the one defending them against journalists, announcing new products, explaining the tech. He's very vocal, often combative.
And the old guard, Jean-Louis Vanderbilt.
The longtime CEO, yeah. He and Stuart Hoegner, the general counsel, they've been there through all of it. Hoegner specifically is the one who had to navigate all the legal storms we're about to get into.
And that's the thing that gets me. We know these names, but we don't really know the structure, do we?
No. It's a private company. There's no public shareholder list. We don't get board minutes or the kind of audited financials you'd see from a public company like Coinbase or, JP Morgan. It is, in many ways, a black box.
Which is the perfect segue, because you can't have a black box with almost $200 billion in it without making regulators very nervous. So here's where it gets really interesting. We need to talk about the controversies.
And we need to be precise here. There's a lot of FUD out there, fear, uncertainty, and doubt. But the sources we have, these are legal settlements. These are facts.
Okay, let's start with New York. The 2021 settlement with the Attorney General. What actually happened there?
That was a big one. The NYAG was investigating an $850 million loss at a payment processor that Bitfinex was using.
Wow.
The allegation was that Bitfinex lost access to this money and then dipped into Tether's reserves to plug the hole, all without telling customers.
So using the savings account to cover the checking account overdraft, but on a massive scale.
That's a good way to put it. The findings were significant. Tether settled, paid an $18.5 million fine. They admitted no wrongdoing in terms of, intent, but the settlement documents revealed that at certain times, Tether had no reserves backing the token one-to-one.
Wait, hold on. Zero.
For specific periods, while they were moving funds around to cover that loss, the backing wasn't there. And as part of that deal, They were banned from serving New York customers.
Ah, so that's why.
That's why if you live in New York, you generally can't use Tether legally.
Okay, so that's New York. Then the CFTC, the Commodity Futures Trading Commission, came knocking that same year, 2021, and they wrote an even bigger check.
Yep, a $41 million fine. The issue here was all about the claim fully backed. For years, Tether had marketed itself saying every single USDT was backed by a traditional US dollar sitting in a bank account.
Cash in the vault. Simple.
Exactly. But when the CFTC cracked open the books, so to speak, they found that wasn't strictly true. For a long stretch, between 2016 and 2018, the reserves weren't just cash.
What were they?
A mix of things. But the one that really jumped out to regulators was unsecured receivables.
That's fancy accountant speak for an IOU, right?
Basically, yes. It means an entity, often a related party like the exchange Bitfinex, owed Tether money, and Tether was counting that debt as part of its backing.
Okay, hold on. If I tell everyone I have $1 million in the bank, but $500,000 of it is just a note from my brother saying, I'll pay you back later, I'm technically lying about my liquidity.
And that was exactly the regulator's point. They said these were untrue or misleading statements, and they slapped them with a $41 million fine.
Which, in the grand scheme of things, still feels like a slap on the wrist. But it opened the door to that really scary narrative that took over in 2021. The commercial paper panic. I remember this vividly. Everyone was terrified. Tether was backed by debt from, failing Chinese real estate developers.
This was peak fear, 2021, 2022. To understand it, you have to know what commercial paper is. It's basically short-term corporate debt. It pays a little interest, unlike cash. And Tether admitted they held vast amounts of it, tens of billions of dollars.
But did they hold the Chinese property debt? Was that rumor true?
Tether specifically denied that. They said they had no exposure to Evergrande or those specific entities. The market was terrified, though, because Tether wouldn't say who the issuers were. It was totally opaque.
But they fixed this, right? The sources say that's all gone now.
They did. And to their credit, they executed a massive de-risking strategy. By late 2022, they announced they had eliminated all commercial paper. They rotated almost entirely into U.S. Treasury bills.
Which brings us to the absolute irony of this situation. By playing it safe, by doing exactly what all the critics wanted and just buying T-bills, they accidentally turned into one of the most profitable companies on the planet.
It wasn't an accident. It's just the business model working at an incredible scale. And if we connect this to the bigger picture, it explains why they're so powerful today.
Let's look at the numbers. The profits for 2025.
Over $10 billion.
$10 billion. In profit, I want to pause on that. That puts them in a league that's hard to even comprehend.
It puts them in the same weight class as, a BlackRock or the real heavyweights of Wall Street.
But here's the difference, and this is the part that just blows my mind. BlackRock has, roughly 20,000 employees? Goldman Sachs has 40,000. Do we even know how many people actually work at Tether?
It's murky, but the estimates usually hover around 50 to 100 core employees.
That's insane. That makes them arguably the most efficient company on the face of the planet in terms of profit per employee.
It is an efficiency monster.
Yeah.
And it's all because of that business model. I mean, think about it. You give them $100 cash, you get 100 USDT tokens. They take your $100 and they buy a U.S. Treasury bill paying, let's say, 4 or 5%.
And they keep the interest.
They keep all of it. You, the user holding the token, you get zero yield.
So they're a money printer. As long as interest rates are high, they're making billions, completely risk-free on the asset side.
Precisely. They're keeping the yield that in a normal bank account might, partially get passed on to you. But because users value the utility of the tokens so much, the ability to move it anywhere, instantly, they're willing to forego that interest. It's the greatest carry trade in history. We give them an interest-free loan, and they invest it in the safest asset in the world.
But they aren't just sitting on this pile of cash, are they? I'm seeing something in here about gold. Tether Gold, XAUT.
Yeah, XAUT. This is part of their diversification.
Yeah.
They aren't just tokenizing dollars anymore. Now they're tokenizing physical gold.
Okay, how does that work? Is it like a paper certificate or something?
It's a token on the blockchain, just like USDT. But each token represents 1 troy ounce of actual physical gold sitting in a vault in Switzerland.
So if I buy the token, I own the gold.
Ideally, yeah. The strategy is pretty interesting. They're pitching it as a hedge. Gold is the traditional safe haven, right? But physical gold is heavy, it's hard to transport, hard to sell quickly.
Yeah, you can't exactly shave off a piece of a gold bar to pay for your coffee.
Exactly. So they offer crypto-style flexibility. You can trade it 24/7, you can use it in DeFi protocols as collateral. It's combining that hard asset backing with digital speed.
But, and I feel like I'm being the buzzkill today, what's the catch? Why wouldn't I just buy a gold bar and, I don't know, bury it in my backyard?
The catch is exactly what we talked about with the dollar token. It's called issuer risk.
Yeah.
If you have a gold bar in your backyard, your only risk is someone digging it up.
Or me forgetting where I buried it.
Fair point. But with Tether Gold, you're introducing layers of trust. You have to trust that the gold is actually in that Swiss vault. You have to trust Tether to honor the redemption. You have to trust the smart contract not to have a bug.
So if Tether, the company, goes down or gets shut down by regulators, my digital gold could just be stuck in digital limbo.
Correct. The sources are very nuanced about this. If you want crisis-proof wealth, like end-of-the-world insurance, you buy physical bars. If you want liquidity and speed and you're willing to accept that issuer risk, then you look at the token.
It's a trade-off. Convenience versus absolute control.
Always. And for a lot of institutional investors, that trade-off is becoming more and more acceptable. We are seeing more adoption of XAUT in 2026.
So let's try to pull this all together. We have this $185 billion giant. It survived the crypto winter. It survived huge regulatory fines. It rotated out of risky debt and into the safest U.S. treasuries. And now it's making $10 billion a year in profit.
And it's all run by this small private group of early crypto adopters who operate with a level of opacity that just drives Wall Street completely crazy.
It really is a fascinating contradiction. On one hand, they're arguably way safer than they were in 2021 because of the T-bills. But on the other hand, they're so big now that the stakes are just infinitely higher.
And that is the key takeaway for you listening. Tether has de-risked the asset side of the balance sheet. The T-bills are safe, but the issuer risk is still there. You are fundamentally trusting the entity. You're trusting Paolo, Giancarlo, and that team.
And you're trusting that the U.S. government will just continue to let them operate. That's the big question mark, isn't it?
It is. They've woven themselves into the global financial plumbing. They're a massive buyer of U.S. debt.
Which leads me to my final thought for everyone listening, and it's a bit of a provocative one. If Tether is now holding billions upon billions of U.S. treasuries, and they're the main way people in emerging markets get access to the dollar.
I know where you're going with this.
Are they simply too big to fail? I mean, if regulators really decided to clamp down, hard shut them down tomorrow, wouldn't that crash not just the crypto economy, but maybe even cause a hiccup in the traditional bond market?
It's a valid question. You know, when you owe the bank $1 million, you have a problem. But when you lend the government $100 billion, the government might have a problem if you suddenly disappear. It's a symbiotic relationship now, whether the regulators like it or not.
A symbiotic relationship worth $185 billion. We'll have to see how the rest of 2026 plays out. That's it for this deep dive. Thanks for listening.
See you on the next deep dive.